Next time you're out for a walk in the forest, consider just how much had to go right for it to flourish. Rich soil, enough rain and sunlight, favorable climate, avoiding nasty natural disasters. There are many risks that could have stunted the forest's development. And there's a parallel here that growth investors should take to heart. Remember, growth stocks are generally higher risk, likely higher reward, and there are many challenges they need to overcome. So let's run through some of those risks to give you a better sense of what might be in store. And a little later, we'll touch on some ways to mitigate those risks. The first major obstacle is something called execution risk. For a growth company to fulfill its ambitious business plan, it will need to continually improve a product or service that customers want, effectively market and sell it, stave off intense competition from competitors, stay one step ahead of technological developments that could make their product obsolete, and okay, I think you get the point. It can be very difficult to pick successful growth stocks because of all of these risk factors. And if the company isn't successful for whatever reason, the stock's value might drop significantly. Think of execution risks as weeds in the forest that compete with the trees for resources. If too many weeds pop up, the trees won't have enough nutrients they need to fully grow. The second major risk is that growth companies often lack a lengthy track record in business. They're trying to succeed with a new product or within an entirely new market. So it can be tough to gauge how effectively they'll generate revenue and profit, and if the stock will appreciate at all. The company might not gain traction with customers despite having what sounds like a great product. Perhaps the management team can't execute on their vision very well. Or maybe the competition simply delivers a better product. Contrast that to more established businesses that have a proven business model over many years. This makes growth companies more uncertain, like a tree sapling that recently took root. It hasn't dug deeply into the soil just yet, and could be swept away by a flood, for instance. The third risk we'll cover is that growth stocks tend to react sharply to news and events, which makes them more volatile. It could be something specific to the company, like a new product hitting the market or the latest quarterly financial results, but it could also be something broader, like new government regulations or economic conditions. For example, a country's food and drug regulator could approve a pharmaceutical firm's new treatment, which could send its shares soaring. Or a country's transportation agency could opt to ban ride-sharing services, which might cause shares of those companies to tumble. Recall that a growth stock's price largely reflects the expectations investors have for its future profit. So positive developments may inspire confidence that the company will attain those earnings, while negative developments might sour investors on those prospects. Think about our tree sapling again. When weather conditions are favorable, it will grow extra quickly. And when conditions are poor, it will suffer more severely. The fourth risk to keep in mind, growth stocks usually don't pay a dividend. So investors are often relying entirely on the share price to rise while they hold the stock. If that doesn't happen, then investors could be left with nothing to show for their time and money. This makes growth stocks a little like a young apple tree that doesn't produce fruit just yet. Investors looking for an immediate snack might want to look elsewhere. The last risk we'll touch on is that growth stocks often aren't traded as frequently as established ones. As a result, investors may find there is a wider range between the bid and ask prices for growth stocks. They might need to pay more than they want to buy shares, or sell them for less than they want to in order to get rid of them. This is a bit like going to a farmer's market to buy a tree sapling. You'll likely find different prices from different vendors for the same type of tree. So you'll have to pick your spot a little more carefully to end up with a price that makes you happy. This isn't as often the case with larger, more established growth stocks, but investors should be aware of this dynamic nonetheless. Now, this is far from a full list of potential risks with growth stocks, but as you can see, investors should be more mindful when choosing them. There are a few steps that savvy growth investors commonly take to help limit their overall risk. One, they can diversify their portfolio beyond growth stocks. How much depends on an individual's investor profile, risk tolerance, and investing time horizon. Generally, investors with high risk and volatility tolerance, as well as a long-term runway, might hold a significant portion of their portfolio in growth stocks. There's simply no hard and fast rule here, so know who you are as an investor. Two, they can cap the size of any individual position. A general rule of thumb is to only hold as many stocks as you can adequately track and afford. For example, some investors limit each position to a certain percentage of their total investment. And three, they can focus more on growth stocks already turning a profit. This could lower their chance of investing in a growth company that goes bust. Whichever steps you decide to take, just make sure you have a firm grasp of the risks involved. Otherwise, you might miss the proverbial forest for the trees.